Hey, what's up, everybody? My name is Ryan, and I am a licensed financial professional. And today I'm just kind of making a video going over the pros and cons of an IUL. And so I'm really kind of going in depth on this, just kind of giving everybody a good understanding of really just how it works. And so let's go over the pros really quick. The pros of an IUL are that there's no stock market risk. There are no contribution limits. There are no age restrictions on when you cannot get an IUL. There's no 59.5 rule. Also, you can easily access these funds with no taxes and no penalties. And there's no required minimum distributions once you hit age 72, like most other types of accounts. Also, you get market-like returns. The money grows and accrues interest within the IUL tax-free. You also get a tax-free retirement income. The death benefit, you get a death benefit and you also get living benefits as well. There are minimal fees if structured correctly, which I'll go into later. And the income does not affect whether or not you'll have to pay taxes on your Social Security and or if you qualify for Medicare. And so let's kind of go a little bit more in depth on all of these pros of the IUL. And so you'll see here that the first one that I've pulled up here are the tax advantages. So with the IUL, because of tax code 7702, you are able to access the funds tax-free and penalty-free because you're under that umbrella of life insurance. And so you get to leverage that specific tax code. Same thing applies with tax code 72E. You only get to leverage this tax code when under the umbrella of life insurance. And what this tax code allows you to do is all the interest that you're earning and all the interest that you're accruing within the IUL is all being accumulated tax-free. And because of tax code 101A, all that death benefit, once you pass away, is then going to be passed down to either your trust or to your beneficiaries or whomever, tax-free as well. And again, you get to access those funds tax-free at any time throughout your life. You don't have to wait until you're 59 and a half. You don't have to wait until there's like a certain amount of time. Again, it all depends on how it's structured. You could access those funds after 30 days if you wanted to. Again, no penalties and no taxes. And with that tax-free death benefit, a lot of people think that it might count as income. It does not count as income. So if your children end up inheriting your death benefit, that's not going to count as income for them, and they're not going to have to pay income taxes on that, fortunately for us. And then if we talk about the fees now, the fees I actually have as a pro on here, because the fees allow the IUL to be classified as life insurance and not an investment. You know, a lot of people are like, oh, the IUL is not an investment. You're damn right it's not. Because with investments, you bear risk and pay taxes on investments. You don't bear any risk and you don't pay taxes with life insurance. And because of that, with those fees that are implemented onto the policy, that's only because that there's an attached death benefit with this. So the fact that there's a death benefit and the fact that you're under the umbrella of life insurance is the reason why there's fees, but that's also the reason why you're able to take advantage of this accruing interest tax-free and accessing the money tax-free and taking out loans from the insurance companies while your money still accrues interest, right? And then the next point here, you'll never get a bill for these fees. The IUL literally pays for itself. At the end of the year, the fees are due and the interest gets credited. The fees get subtracted from the interest, and whatever's left from the interest then gets paid into your policy in the form of cash value. You're never going to get a bill at the end of the year saying, here are your fees. No. The interest that the policy accrues will always pay. Those fees, giving that you actually earned any interest that year in the stock market. And so you'll notice that fees also pops up in the cons as well, and I'll talk more about that in the next coming slides. And the IUL fees are much lower than manager fees, right? Your financial advisors who manage a Roth IRA or 401k or who manage your mutual fund or your index funds, their fees are much higher than the fees inside of a properly structured IUL. Now let's talk about the policy loans. So the policy loans are very, very, very cool. You get to leverage something that's called uninterrupted compound interest, which essentially just means that you put your money into the IUL. Then come the time that you want to start taking loans out of your policy, you're not taking money out of your IUL. Your money continues to stay in your IUL earning interest, tax-free with zero market risk. What you are actually doing is taking a loan from the insurance carrier, right? Because they're just going to use the money inside of your IUL as collateral. Basically, they know you're good for the money because you got it sitting inside of the IUL, which you hold with them. So they're going to give you their own money, and you're going to be able to go put that wherever you want. And your money never left the IUL, so you never stopped accruing interest, hence the name uninterrupted compound interest. The flip side to that is also there's a 0% floor. So you're never able to lose money due to market volatility. So comparing that to other types of accounts like a 401k, a Roth IRA, just the general stock market, every time the stock market goes down and you're in a downward trend, you're losing money, your interest, your compound interest is getting interrupted by the downward trend of the market. And now you're having to play catch up because you just lost 10%, but now the stock market's steadily going back up. So now you're making all that money back, which you lost. And every single time the stock market goes into a downward trend, you're interrupting that compound interest. But because the IUL has a 0% floor, again, you're never having to play catch up. You're never losing money. So that compound interest is never getting interrupted. And another super cool thing about the loans is that you never have to pay those loans back. Because if you take out a $200,000 loan from the insurance company because you have a cash value of $200,000, so the insurance company will give you a loan up to the same amount of money that you have in cash value, and let's just say you never pay that loan back and you have a $1 million death benefit, the insurance company is literally in debt to you of $1 million. It's a guarantee that you will pass away at some point in your life, so they are literally guaranteed to pay out this $1 million death benefit. And so if you take out a loan from them for $200K and you never pay that loan back, well, when you pass away, you still have an outstanding loan of $200,000. And so they're just going to subtract that from your death benefit, and your beneficiaries or the trust, which you have, whoever you have is deemed as your beneficiary, is just going to get paid $800,000 instead of $1 million. And a super cool thing about these policy loans is that they have very low interest rates, anywhere from about 2 to 4%, depending on the company that you use. And you never have to qualify for these loans. They don't check your credit. You don't have to qualify. You don't have to submit an application to get a loan. It's your money. If you have that matured cash value, if you have an established cash value, then they're going to give you a loan based on how much you have in cash value. There are also living benefits as well. So you get access to the death benefit while you're still alive. If you ever become critically, chronically, or terminally ill, you can start taking out money from your death benefit to go ahead and pay for those medical bills. If you are the breadwinner of the family and you're not working because you're sick and the family has to be still paying bills and paying the mortgage and buying groceries and stuff, you can be taking money out from the death benefit to cover that income that's no longer coming in, to pay for those bills, to pay for long-term care, for all those things. And there's also no market risk with the IUL. And the reason why there's no market risk is because there's a 0% floor on here. The money that you are putting into the IUL is not directly invested into the stock market. So you don't actually literally participate with the ups and downs. You only mirror the upward trends, but you do not mirror the downward trends. And you have a complete downside protection of the stock market so that you won't be very mad and upset like this guy is right here in this little GIF that I threw in here, right? You'll never have to experience that feeling. And so it's just that really nice kind of safety blanket, safe haven. You know, in the back of your head, no matter how the stock market performs, you're never going to look at your policy and look like that. Now let's start talking about the cons of the IUL. So some of the cons of the IUL are that there are bad agents out there. And if not structured correctly, the fees can absolutely ruin your policy. And depending on your age and your health, the cost of insurance could also ruin your policy as well. And there are long-term commitments, which I'll get into. And there is performance risk. Also, it all depends on your timing and age. This could definitely be a negative impact on your policy. So let's dive more into this. Again, like I was just mentioning, there are bad agents out there. Agents can be greedy. They could have commission breath. They could very well put their best interest before yours. Or you just get an agent who doesn't know what they're doing. They don't know how to structure an IUL properly for cash value accumulation. I call it a high cash value IUL. Other people call it other different names. But essentially, you're only getting the IUL for it to act as like a high yield savings account or a hedge against inflation, that type of thing. You're not really getting it for the death benefit, right? And so why do I say like greedy and commission? Like what does that have to do with it, right? The more death benefit the agent gives you, the higher their commission is going to be because the more insurance they're selling you, right? But the higher the insurance, the higher the death benefit, the more the cost of insurance and the higher the fees. The higher the fees, the more that eats into your growth and your gains. And obviously, if the cost of insurance and the fees are eating up all of your gains and all the growth in your policy, then it defeats the purpose of having the policy and you're not going to see any growth or gains. Literally, you're just going to be paying for fees and the cost of insurance, which a lot of people don't want to do. So if you have a bad agent who's greedy and is just looking out for their wallet and is giving you much more death benefit than what you really need just because they want to get a bigger commission, then your IUL is not going to perform well at all. And then that in turn leads right into the fees, right? The fees are based on your death benefit, and it can absolutely ruin your policy because if the fees are so inflated because the death benefit is unnecessarily high, then you are literally going to be screwed. Like your policy is not going to perform at all, like whatsoever. And then that is also going to make that cost of insurance be very high as well. So not only the death benefit matters for this, it's also based on your age. It's also based on your health rating, because the older you are, the more likely you are to die. So the higher the cost of insurance, right? The health rating, the less healthy you are, the higher the cost of insurance, because the less healthy you are, the more likely to die that you are. And the cost goes up as you get older because, again, the older you get, the more likely you are to die. But the way that I kind of hedge against this is something called optimal switch. The older you get, once you hit 65 or around then, whichever age you tell me that you want to stop contributing to your IUL because you want to retire at that age, we stop contributions into the policy because there's no more money going into the policy. We optimally switch that death benefit from increasing to level, so the death benefit does not get higher anymore as you grow older, to just eliminate that cost of insurance going up. And then here we have interest rate risk. If you earn 0%, then what's going to happen is, again, stock market goes into a downward trend. You do get saved by that 0% floor, right? You're not going into the negatives. You're not losing any money due to market volatility. But because there was zero interest gained that year, remember what I said? Fees are due at the end of the year. Interest gets credited into the policy. The fees get subtracted from your interest, and then everything left over in the interest gets paid into the cash value. But if the fees are due at the end of the year and you earn 0% interest that year, there's nothing to eliminate those fees. So the next thing that's going to happen is that the fees are just going to get subtracted from your cash value. And another thing with the interest rate risk is that there are no guarantees with the IUL. I guess really the only guarantee is at 0% floor, you'll never lose money. The worst that can happen is that you just earn 0%. But in terms of like a guaranteed 10% or 5% or 3% or whatever it may be, there's nothing like that with the IUL. Guys, thank you so much for watching this video with me. Hopefully you guys got some value. If there's anything that I missed in the pros or the cons, make sure to let me know in the comments so I can address those things. If you're in the market to purchase your own IUL, again, like I said, I'm a licensed financial professional. I specialize in structuring high cash value IULs. And so if you are interested in opening up your own IUL, I'll have a link in the description to book a one-on-one Zoom meeting with me.